So we'll get started here. My microphone is connected to the recording. I want to just stream my other screen to you guys to make sure we're all looking. Okay, so we're all familiar with fundamental analysis. We're all aware of what fundamental analysis is, and a lot of people, you know, talk about it. But most trading lessons and most trading discussions are held by technical analysis. And technical analysis is a very, very small percentage of trading. And a lot of the time, traders will actually benefit more of fundamental analysis. Okay. But we need to understand what fundamental analysis is. I've watched millions of videos of technical analysis. Some things work, some things don't work. Whereas fundamental analysis is kind of like a straight journey. It's kind of like you can't really get it right or wrong. It's just kind of straight, right? Whereas technicals, obviously, you're going to be doing them yourself, so it can be quite difficult, different, kind of that element. So you've got that element of failure potentially. So all I'm going to do first, we're all aware of the Forex Factory, I assume. If you're not aware of Forex Factory, this is just a website that we use to bring out the economic data. So this is going to be data releases that are given by hedge funds give some data. We have the Fed's giving data. We have just inflation and employment claims, all that type of stuff coming out. Biden talks a lot. Powell talks a lot, and all these figures that you'll start hearing about the more you get into your trading journey. But why do they matter, and why are they important to us, and how can we decide if news that's coming out is good for us or bad for us? And we'll go through that now. And then I'll also be going through COT data. Okay. This lesson is going to be very long. Okay. So strap in, get locked in, get your notepads out. And if you are watching this video, right, this is all you need to know about fundamental analysis basics. Okay. Obviously, you can go into the more nitty gritty where you're looking at statistics and you're comparing percentages and numbers and all this type of stuff, but it's boring. We're not here to be, accountants. We're not here to be, these business and, finance majors. We're here to trade, right? So we want to look at a chart and go, okay, we want to go short because they're going short. And then that's basically it. So I'll explain it in that regard where it's just simple. But just to get started, I'm just going to be reading from my notebook. So macro news is what we want to be looking at. So the macro news is basically the central bank giving us statistics that they've discovered over the past week. I want you to keep in mind that the statistics and the information that comes out is going to be lagging data. So it's going to be data from either the prior month, the prior quarter, or potentially the prior year. So this is going to be slightly lagging data. And I want you to understand that this data is something that is going to affect the sentiment in the market, but not the market directly, if that makes sense. The things that will affect the market directly are things like war, things like massive monetary changes. We have like big news articles coming out, maybe a crash in a certain market or things like that. But when we talk about inflation, when we talk about unemployment, these are just going to be elements that are going to give a slight hit to the market and going to change the sentiment of traders, hedge funds, banks, CEOs giving their data and things like that. Okay. So just to be aware of that. The two key things that we look for information from the central bank is inflation and unemployment. Let's talk about inflation first. So inflation obviously is how much we are going to be spending for our average costs of, our domestic products, how much you're going to be earning and things like that, interest rates and all that type of stuff come in. Unemployment is a reflection of inflation. It gets a bit technical, but unemployment, of course, is basically how many people are employed and how many people are unemployed. And if the kind of country is heavily unemployed for a certain month, or statistically over a period of time is heavily unemployed, then that's a reflection on people buying things. That's a reflection on people being able to pay their mortgages, their rent, their bills, electricity, and then that will have an impact on the central bank. And then, we can then trade from that news. If employment is good and everyone's employed and the salaries are okay, guess what? They're going to be pumping that money into the economy, which pumps the economy up, which is great for everyone. Okay. Remember, it's lagging. It's lagging information. So the data that comes out is the month prior. And also when we go into COTs, that is when that data comes out. It's a week prior. Okay. So it's not something that we can look at properly in the given time that we get given it. Okay. So we can talk about the big news that come out. So we have CPI. Okay. This is basically a discussion. This is consumer price index, I believe, off the top of my head. This is basically inflation that comes out, how they talk about it, what's happened on the previous month, and the mandate to keep inflation okay. This will get released on how they're going to deal with the inflation that comes out. If it comes out really bad, the inflation is really bad, they're going to talk about how they're going to deal with that. If it comes out good, they're going to talk about how they're going to deal with that as well, and how to keep the economy pumping and not allow everything to get quite ridiculous, right? We also have PMI. PMI is a forward-looking one. Okay, so this is a forward-looking indicator. So when PMI comes out, this can be a prediction for the next month. So what this is basically entailing is the banks and all these guys will go to CEOs of big corporations and they will give them a survey and ask to see their outlook on the economy. How are they looking to purchase more warehouses? Are they looking to purchase more products? How are their costs for goods costing, and are their prices for their goods going to increase to retail buyers like us? Say, for example, you buy an iPhone. If an iPhone is $1,000 last year, but now an iPhone is $1,500 this year, that could be a good reflection that companies are having to spend more for their materials. Companies are spending more on labor and things like that, which may not be a good look on the economy, but it also may be a good look on the economy because people are going to be spending more money to Apple, and then Apple are going to be putting more money into the economy for taxes, and then that keeps the circle running. So it's kind of like a give or take. It depends on a lot of context. Okay. So, um, we have to have a look at average earnings and retail sales as well. So we have a look at average earnings. How much is, am I earning? If last year I was earning $1,000 a month, but this year I'm making $700 a month, that's not a really good look on average earnings. Okay. If I'm earning less, that's more money out of my pocket. That means there's less money going into the economy and buying things. We need to look at retail sales. We need to look at big ticket items like mortgage houses, right? Are you buying a car? How many Audis were sold last year? How many Audis were sold in the last month? And this is a massive reflection on how the economy is running. Okay, so there's all these things that go into all these statistics, and we are able just to look at one statistic and it tells us all this information. But it's good to have the core understanding of what actually goes into this information, into these statistics. And then, of course, we have housing data, sales, and things like that. And when we also look at the retail sales, we also need to think of the top of my head, I can't remember what it's called. It's products that you buy. It's products that a consumer would buy, like a fridge or a washing machine or a dishwasher. Things that are quite expensive, like they're quite a high ticket item, but they're durable, they're long lasting. So you don't have to buy them over a long period of time. And they're not necessarily massively essential. Okay. They're essential to live and things like that, but you also don't have to buy them every single year. So let's say, for example, we have a massive influx of people buying dishwashers. Okay. For example, that is a really good reflection on the economy because people have that extra income that they can then go and spend on a brand new dishwasher. Literally, I swear to God, guys, it's very small things like that that really reflect on the economy. And they look at things like this. What are people buying? What are people selling? Are people moving? Are people having mortgages and then moving to renting? Are people buying new Audis? Are people financing new Audis? Are people buying cars outright? All that type of stuff goes into it. And then we get these statistics, okay? And then, of course, the well-known one is FOMC. FOMC is the meeting to review everything on interest rates. So obviously, interest rates come from the banks. How much money are the bank making? How much money are they? Because a lot of time we have quantitative. I think it's called quantitative tearing. Correct me if I'm wrong, guys. I'm not 100% because there's a lot of information I've got to retain for this video. But it's basically where the government are buying back the banks buying back the government bonds. Okay, and that's pumping more money into the bank, so then the bank can ease out interest rates. Okay, so the FOMC will basically go and look at those statistics, look at the statistics from consumers and all this type of stuff, and then they will give us a reflection on in the FOMC meetings to basically say how the interest rates are doing. Are they going up? Are they going down? If they're going up, that could be a bad look because why are they needing more money? If they're going down, it's a good look because it's showing the economy is healthy. In regards to, okay, so in regards to Forex, if there's any Forex traders in here, we will look at the economy statistics. So, for example, we have EPC and we have MPC. These are going to be meetings for um, these are going to be meetings for the euro, and these are going to be meetings for the GBP, so the Great British Pound. We're going to look at these meetings. Similarly, we're going to look at FOMC for the USD. Okay, so a lot of people don't take these into account when trading the euro or the pound. They do not watch the MPC or the EPC, and we don't have to watch them, of course, but we need to look at the statistics, right? Let's say, for example, we're trading 1 week and the market's really, really bearish. Then all of a sudden we go to see the MPC news come out and it's actually really good. Therefore, we can go to that individual pair and then potentially look for longs on it. And then obviously when we go throughout this lesson, I'll introduce you other things to help you with that as well. Okay, moving on. So we also have PPI. This is just what our raw material costs. So if you are if you're Apple, let's go for Apple because Apple's quite a simple one. It's not really data, it's not technology or software. So Apple obviously have to buy certain metals for their phones. They have to buy lithium batteries. They have to buy this. They have to buy that. All these type of stuff. So PPI is basically what are Apple spending to be able to create these products. And if they are spending more than they were previously, of course, that's not a good look. Okay, that shouldn't happen. You should be paying less, if anything. So what the products cost for the consumer as well, reflection, and then GDP. Of course, everyone knows what GDP is the health and how much does the bank have basically? How much does the bank have? How much is the bank giving out? Can you do loans? The worst thing for the economy is if the bank can't do loans, okay? Or the banks increase interest rates so you can't get a loan. Really bad reflection on the strength of the economy because you should have a healthy bank that says, yes, you can have a £10,000 loan tomorrow at this reasonable interest rate, pay us back over a period of time, etc., etc. Okay, so that's mainly the stuff on the news. If we just go onto this website now, you guys can watch my stream instead of just listening to me. If you guys go onto my screen now, you can see Forex Factory. This is forexfactory.com, a very simple, easy website to use for trading. It will give you each and every single economic data that's coming out. So if you're an AUD USD trader, you would look at 12:30 a.m. our time, UK time, by the way, guys, at the CPI coming out. Okay, and as we all know, CPI is inflation. So it's a reflection on inflation quarter over quarter, year over year. Okay, so we want to kind of be looking at if we're trading the AUD, is it good, is it bad, and then we can click here if you guys forget stuff from this lesson, and we can click this graph here, which shows us the statistics, it shows us what's happened, and then I believe we can click this folder here that tells us everything we need to know. So if we go on to the AUD CPI quarter over quarter, usual effect is actual greater than forecast is good for currency. Okay, it's good. So if we're trading AUD USD and the forecast is 0.8 and it come out above 0.8, okay, that's really good for AUD, and that can, I'm not saying it can cause AUD to have a move towards the top side. However, in this example, AUD was not good. Okay, AUD news come out 0.6% and the forecast was 0.8%. So if we look at the usual effect, it should be bad for the currency. So AUD USD should have gone down today. But of course, I believe, this was yesterday. No, sorry, that was Wednesday. We can have a look back on Wednesday and see how that played out, and that's kind of the back test that you can do. Just simple, just go onto your chart, have a look at what news come out, have a look at the pair, the currency, and then see what it does. For people that trade futures, for the people that trade options, okay, everything is going to be run from SPY, of course, or ES. You're going to be looking at the USD. Only look at red folders, okay? Orange folders don't really mean too much, okay? They don't really mean too much, and we won't look at them, just look at the red folders. So let's have a look at the news today, potentially. So we have USD, non-farm employment change, which is a really bad one. We can click on here if we need to know what happens. So the usual effect is actual greater than forecast is good for currency, okay? But as you can see, the forecast was 187K and the actual was 350K, okay? So what happened? The market did actually sell off today. So that's not a really good reflection on what I'm teaching, but it's showing you to not always have a bias just from the statistics that come out. And typically the moves happen as the news comes out. So you can't really predict it in that regard. Okay. However, what we can do is potentially use this good news. This bad news. So we don't want it. The employment change is good. Okay, so it's good news. So we could potentially use this good news going into next week for ES and potentially have a bit of a more long bias, right? I am reading this right. Am I? Non-farm employment change. We actually had it. Yeah, this is not unemployment. I was thinking it was unemployment. But yeah, so that's good for currency. We did have a sell-off today, so it's not a kind of thing where it comes out and you go, right, guys, buy ES, buy SPY. That's not the case. We will wait it out for a little bit. This news could kick in potentially 2 weeks, 3 weeks down the line. A lot of people will go, and I've heard it a lot in VC, a lot of people go, oh, it's actually good for currency because we're above the forecast, but then it would dump and they'll have the wrong bias and they'll be trading the wrong side. So don't necessarily look at this data immediately, potentially use it as a bias for the future. Okay. I think that's everything covered on this. It's very plain and simple. It's got graphs to show you the history and things like that. And then it's, of course, if you go onto the folder, it will tell you the usual effects, and then you can trade from there. And then mainly look out for the red folders. News comes out per month, per quarter, per year, and per week. Just look out for the big ones like FOMC, CPI, PPI, GDP, any others that I could think of. PMI is a good one because that could be actually a good look for the future. And then remember, it's based off sentiment of the market. It's the sentiment of investors. Are people, you need to sit there and think, are people that are in pension funds, are people in pension funds or your 401ks or just general investments of people, like I own my own private investment fund, and we will look at the statistics and decide potentially what could happen in the future. So then we can decide on our investments for our clients. Okay, so I'm quite heavy into this, and you should do that too. You should sit there and think, what are other people going to be doing? And I have an amazing tool to show you guys that can help us with deciding what other people are doing. So all of this is free. You don't have to pay for any of this. I definitely wouldn't pay for anything. I hate paying for subscriptions for trading stuff. In regards to boring news like this, obviously our subscription is absolutely amazing. So that's an okay one. But when we come into like Forex Factory, dart pools and stuff like that, it does get quite tedious buying subscriptions for all these like services. So I'm trying to show you guys free ones. Sometimes they're a bit lagging, but it's okay. Right, now we can go on to Trading Star. So Trading Star, let me just make sure that's changed on there. There, okay, everything's good. Okay, so Trading Star is an independent company that have created this website for free. So if you guys do not know, the banks, investors, hedge funds, all these big companies, pension funds, and all these big companies have to declare what they're buying and selling. They have to share their trades. Okay, this sometimes can be through dart pools. This sometimes may be through options flow and all this type of stuff. Different markets will present different data. Okay, what this data is COT reports. Okay, COT stands for commitment of traders. Okay, so it's just what are traders committing? What are they looking for? What are they buying? What are they selling? And what we'll go do is we'll have a look at the statistics. I'll explain what all the sections are so you guys understand. And then we'll go look through some examples and how we potentially could have traded them. Okay. One thing to be aware of is that these statistics are a week late. Okay. Again, back onto the sentiment. What is the sentiment of traders? So what we're going to do is we're going to look at the statistic, and the statistic that we're going to go through it comes out every Tuesday. So it came out on the 30th this week, I believe. And the statistic was around the 26th or something like that. That was for the week. I'll explain it more in depth with a chart because it's easier to talk with a chart. But let's go on to my paint now, or my snipping tool, and then we can actually start analyzing what we have in front of us. So that's on there. Just need to change it on the Discord. Guys, if I'm going too fast or kind of skipping through some stuff, it is recorded so you can kind of jump back in and maybe just go through some revision. Right. So on the website, I'll show you how to get to this point in time, but we have the Euro FX that we're looking at, okay? So we have the Euro FX, so we're looking at the Euro. What are people doing on the Euro? What are buyers and sellers doing on the euro? What do they want to do? So as we can see, this is as of the 23rd of January 2024. And this data came out on the 30th, like I said. Okay. So this came out on the data was taken from last Tuesday and was given to us this Tuesday. This was what I like to kind of think of as like an accumulation or a distribution. What did they accumulate in? What did they distribute? What actually happened in that given week? And how can we use that information to help us this week? Okay. So you get the last week's information. Let's go through what each and every one of these means. And I'll get rid of the ones that we don't need. So what we don't need is spread. Okay. Spread is what people are making from the bid and the ask and stuff like that. They're basically taking advantage. And sometimes on certain prop firms, it's quite illegal. So we won't look at this. We won't look at other reportables or non-reportable positions. So we're not going to look at any of this either. What we're mainly going to be looking at is these three elements here. And I'll explain what each of them means. So we, of course, have long positions. So this is people buying up. What are people buying up? And then we have short positions. This is what people are, of course, selling. What are people shorting? What are people predicting the market to go down? So we have the dealer. The dealer is going to be the broker. The dealer is going to be the person that issues the shares out. It issues the positions out. Okay. And of course, if they issue, for every buyer, there's a seller. And for every seller, there's a buyer. So the dealer is what we're going to have here. Okay. The dealer is opposite to what an asset manager institutional would do or leveraged funds would do. So let me just make sure this is right. And I say this right because it's quite difficult. The dealer. So if the dealer has increased their short positions, so as you can see here, the short positions have decreased in this example. But let's say, for example, they increased, their positions increased. They have been given shares back. Okay. So they have accumulated more positions than they had the previous week. However, in this example, we can see that positions of short, okay, if the dealer has decreased them, which they have this given week, they had 448,600 positions ready or open for short positions. And if the dealer has decreased them, which they have, it means that they have sold some. So it means that someone has bought them. Okay, so this is quite bearish. When we see the negative positions in the dealer, it means people have taken them off the dealer. If it means positive positions in the dealer, it means potentially people have given their positions back. Okay, so just go through that one more time. So the dealer is the broker or the person that issues the shares or the positions. If the short positions are net negative for the week, okay, it means they have sold some back. Okay, just to make sure we're all aware of that. Open interest and number of traders. Number of traders don't matter. Okay, open interest can be quite interesting. I'll go through that after we go through long. So that's for the dealer. And as you can see, long positions, the market has gave them 518 back to the dealer. So it means people are potentially closing out their long positions. Now we can look at the good ones. So we look at asset manager. Okay, this is going to be the main one. Oh no, I got rid of. Just circle this nicely. 3 straight lines. So we want to look at asset manager. Okay, this is what we're going to have as just pension funds. Okay, this is going to be hedge funds. This is going to be sorry, not hedge funds. This is just going to be investors. This is going to be big corporations buying up shares and all that type of stuff. Okay, so as we can see, we're mainly going to be looking at the positions for now. So as we can see for the asset manager or institutional traders, we can see that they have 476,138 shares or positions open for long. In the last week, they have a net negative of 3,326 positions. So as of last week, they've decreased their positions by 3,000. So you need to sit there and think, if we're looking at these statistics, if the asset manager or the institutional traders have decreased their long positions, do you think the euro is going to pump the next week? Possibly not. Okay. So if they're decreasing their long positions, that might not be a good look for euro. Okay. And we need to trust these guys. They're the genius. Okay. They're the big boys. So we need to trust them, but only with a pinch of salt. Okay. We're not going to take it to the T, and we're not going to all go run into the Euro USD and short the shit out of it. Okay. We're not going to do that. We're just going to use this as a potential buyer's help. And then we can also look at the asset manager institutional trades for short positions. And as we can see, the short positions are sat at 98,368, and they have increased their short positions. They have increased their short positions by 418. So that means they have added to their portfolio 418 positions of short. To me, anything below 1,000 is not something to be concerned about. Anything below 1,000 is like, it wasn't really much. Maybe they don't know. They don't really know what they're doing. Maybe they don't really know kind of what's going on. So they're just kind of working their figures out or doing risk analysis, whatever it may be. Okay, so that's not massively detrimental to us. If this was plus like 20,000, of course, we have to say somewhere like, wow, okay, that's a lot. Why are they getting such heavy positions in short? But then we look back here, and then we could say if they're selling their long positions, so if they've decreased their long positions by 3,000, might be a bias of shortness in the market for the next week. So that is the asset manager and how we can look at that. Now we can go look at leverage funds. So let's draw a nice box around this. So leverage funds, what this is going to basically be is hedge funds. So it's people hedging against positions. Maybe I might be a hedge fund and I might be sat there thinking, right, I'm really, really long on this individual Forex pair. I'm really, really long on here. And maybe I just need to counteract that. So typically what we'll do is if we're trading like USD JPY, make sure you guys follow me because I'm going to go on a rant here. If you're trading USD JPY and USD is the primarily pair, okay, so you are trading against the dollar. Sorry, no, you are trading for the dollar. If you're trading USD JPY and USD is the primary pair, you are trading for the dollar. So if you think USD JPY, if you're in a heavy position, you think, USD JPY might not be doing anything. What do? We leverage. We use hedging. So then what we'll do is buy the euro up, okay? Because the euro is against the dollar. So if the euro is doing good, it will pump. If the euro is doing bad and the dollar is doing good, it will dump. Okay, so we'll hedge. So we'll buy the opposite basically. It's kind of like how would you put it? It's like going long on SPY. Okay, so you're going long on SPY, and then potentially buying, potentially shorting gold at the same time. Okay, it's kind of the idea. Just hedging, just going against your position that you currently got. It may be for many reasons. It may be for you're too heavy in and you can't get out. Maybe you've got you've got an idea, but maybe it's just not fulfilling too close. Okay, so hedge funds. This is leverage funds, and what this is going to basically be is it could be a good thing for us. And we compare these two together. So if we have asset manager and leverage funds and they're doing a similar thing, it's okay. Okay. Just because they're hedging, it doesn't matter. If they're hedging, it's a good thing. If they're buying up the euro to hedge against another position, it's a good thing because they think euro could be going up. Okay. And in addition, if they're hedging, it's even stronger because they're protecting another position. So they're telling us they think the euro is going to go up and they think the USD is going to go down. So it's kind of like a double confluence if the leverage funds are going long. In this example, of course, we have them going short. Okay. So it looks like they're going short at this point in time because they have a minus 4,955 positions. So in the last week, they have decreased their long positions on the euro 4,955 positions, which is really not good luck. Okay. So at this point in time, we might be thinking, oh, so asset managers are decreasing their positions in long, leverage funds are decreasing their positions in long. It might not be a good idea to have a bullish bias on the euro. And then we look at short, and as we see, we have plus 3,422 positions in short that are added to their portfolio. Okay, that's not a good luck either for the week coming. Okay, because obviously it changes every week. We only do these by the week, so we see it in the week, we trade it, we recycle it, and do it again, do it again, and do it again. Okay, it's kind of not like macro news where we could be seeing it play out for the next 3 months. This is just bi-weekly. And if we tie this up with FOMC and CPI, it can be a very good kind of indicator for you. So the last thing I want to go through to make sure you are all aware, because it's very important to be aware of this, is the positions of the individual traders. So we need to look at the positions. So if we should we use yellow? We'll use yellow. Why not? Okay, so we'll go to the dealer first. The dealer long positions are at 20,000, but their short positions are at 448,000. Okay, why? So weekly, they have sold. They have decreased their positions as shorts. Okay, so it means people have bought up shorts, and their positions as shorts are left over of 448,000. So overall, the dealer has 448,000 positions in short, which is not good because people aren't buying them. And they only have 20,000 positions left in long. Okay. So what does that tell us? Let you guys think on that. And then the asset manager, if the dealer gets too complicated, because it does get complicated for me sometimes, because you have to remember that they're a dealer, and if they decrease their positions, it's kind of a good thing and things like that. It can get quite complicated. So genuinely, if you just want to look at asset manager and leverage funds, that's completely fine. You don't have to look at the dealer always. It's not a massive indicator. But let's have a look at the asset manager. So you can see the asset manager has 476,000 long positions, and it only has 98,000 short positions. So overall, the asset managers are bullish on euro. Okay. But, for the short term, maybe they're just looking for a bit of a sell off on the euro. They're covering some of their positions. And then overall, they're looking for a bullish trade into that zone. Okay. And then leverage funds, they have 75,000 shares or open positions in long, and they have 71,000 in short. So they're kind of neutral. Okay. They're kind of neutral. When they are neutral, it will be a good indicator on the week if they're changing their positions, if they're quite neutral. Okay. And then, of course, open interest, self-explanatory. How interested are they? How many positions are being opened up, kind of thing. Okay. And then number of traders don't really matter. So we won't look at that either. So that is an explanation on the euro. This is called, what is this called again? COT. So this is just the COT. So now let's go through some examples because I have some examples set up for us. Has anyone got any questions for this? Anyone got any questions so far? Is anyone overwhelmed? Because it is quite overwhelming. Is everyone good? No? Okay. Oh, do we have one question? Someone unmuted their mic? No? Okay. We can go to a chart and have a look. So what I'm going to do, I'm going to backdate this. And I'm going to show you guys how to backtest it. So let's just jump straight back on here. So we're back on our website. And then all you want to do is go to the currency we trade. If you trade the S&P 500, of course, just go to the S&P 500. And then if you trade the euro, go to the euro. We want to go on to COT. Okay. This will show us the asset manager, institutional, and all this type of stuff. And it will also show us the positions in these guys. Okay. So you can see the dealer doesn't have many long positions open up. It means a lot of people are accumulating longs, and they have a lot of short positions left. So potentially people aren't looking for shorts. And then on the short term, of course, the asset manager, the long term, the asset manager has a lot of long positions. It's probably what the dealer doesn't have many. And yeah, and so on and so forth. Okay. You can compare these charts. I don't really like comparing these charts because they are a bit shit, if I'm honest. They're a bit shit charts. But you can get rid of the not registered ones, and then just keep the dealer and the asset manager, or maybe leverage money, and then it kind of just gives you an idea on how these charts are moving. I have a mention. Let's see who this is. Yeah, no, of course. So we are recording this right now. Recording of this to go over. Yeah, so we are recording, and it may be I do have software, do have AI software that can make some notes, so maybe I can have a look at doing that. But I think the software, you have to be recording on the software for it to work. But I'll have a look. If not, I can just make some notes because I've got notes in front of me anyway. So yeah, don't worry, it is recorded. So yeah, okay, perfect. Right, so yeah, just going back to these prices and their positions, it just gives us a little chart just explaining what the positions are. I remember when I first studied COT, must have been about 8 months ago now, when I was first discovering COTs and how we can trade them. The first thing I thought was, man, let me get a chart. You know what I mean? Let me see a chart on this. And then TradeStar brought out charts and they're rubbish. So it's really good. What I actually want to do is I'm going to see if I can make an Excel sheet of all these statistics that we get given for free. And then I'm going to see if we can put them on an Excel sheet and turn them into kind of graphs. and then potentially we can find better trends over the weeks rather than the months, because these are like the months, like these are giving us the weeks, but they're not really kind of much information. So I'm going to see if I can do that when I got some spare time. But yeah, so we have the positions in short for the dealer, and then we have the positions long. If we just want to get rid of them, if we just want to see asset manager, we can see that since August the 15th, they've been increasing their positions in shorts. If we go back from the August 15th to October, I guarantee there could potentially be a long move in that time. Okay. So you're thinking, well, no, it should be going down, right? If they're increasing their short positions, well, they'll only increase their short positions in a premium. So they want Euro USD to go up. They'll print their positions. They'll be buying their positions, and then their positions will get fulfilled once it comes back down. And then look, they'll start selling those positions. Okay, so it's kind of like the opposite, right? Well, now that's probably what the chart would look like, but that's just them decreasing their positions. Okay, if you see stuff like this and over a long period of time, then you kind of find this area where they've started decreasing their positions here. Guess what? We can potentially start looking for the opposite of that. If they're decreasing their short positions, we go long, and so on and so forth. But let's go through some examples. So if you want to backtest this, go to view historical data. And of course, guys, just to reiterate, you can look at the S&P 500 COTs and see how many people are buying up and selling the S&P, which can help us with our ES trades. I do that as well, but I'm mainly a Euro trader. And we also trade Japanese, Canadian dollar, and the Australian dollar in my investment fund. So those are the ones that I do analysis on. But if we go to the euro and go to our COT, if we go onto the top right here, view historical data, let's just go back to let's go back to November 14th. And then what I'll do is I'll just take a quick screenshot. Yeah, this is kind of nice. So we'll go on this one, and then I'll just put this on my chart and then go back on my chart. Let me just change everything up for you guys just so we're aware. USD. And then what was the date? The 14th. Was it December or is it November? It was November, right? So there we go. There's the 14th. No way it should have done that. That's so jarring. 14th. Okay. And then if we just print this out, we can see that their short positions over this period from here. So you need to remember. So this data was from the 14th, as of the 14th. Okay. So over this price action here, guys. So over this entire price action for the week, this is what they were doing during this price action. So when I first studied this, I thought, okay, here they've gone massively in short. So why has it gone up? It's not. As it was going up, like I said, it was building a short position. Remember I mentioned that. So now let me just go quickly. I know you guys can't see this, but I'm just going to quickly go to my data. So 14th, 21st. So then we can go to the 21st, and that is actually when this got released. So about there. Okay. So as you can see, overall, let's review the data. So now this data has been from the 14th of November over this period of price action. This is what they've done. This releases Tuesday, the 21st of November. We jump on a Tuesday, and I'm like, right, let me look at the statistics. Let me look to see what people have been doing. Okay. So as you can see, the dealer, okay, has been increasing their short positions. What does that mean to us, guys? That people have not been looking for sells. Okay, so people haven't been buying up sells. They've actually been selling their sells. Okay. And as you can see, the asset manager hasn't really had a drastic change in their long positions. And that hasn't had a drastic change. Well, 5,000 in their short positions decreased. That could be a good look for us. So as you can see, the short positions are higher. Sorry, the short positions. Well, yeah, no, sorry. Yeah, the short positions are higher than the long positions. So yes, they've sold a few long positions, but they've sold more short positions. And as you can see, leverage funds, they basically have kept their long positions, and their short positions, they've decreased them. And that's all we need to look at. That's all the analysis done. That's what they've done in this time. So what I'm going to do is I'm just going to close this. I'm going to make this a little bit smaller. Put this like this for our analysis. And then I'm going to draw a box from here to here. So this is what they've done in this amount of time. That's what they've done in here. So then this week rolls over, and what do we have? We have a lot of selling of short positions. We have a lot of short positions get given back to the dealer. And then what did the market do? Yes, we had a small retracement back into a potential demand. If you guys know about trading zones, trading Asian sessions, and things like that, we know that the market typically comes back within a zone to pick up some demand, and then it can carry on. And as you can see, we come back into this demand zone that created this impulse. It came back into this zone, and then from that tap in, it was able to run a solid 160 pips. Okay, so we ran 160 pips for that time. So if we just go on to a potential 5 minute, and we've seen this data release, we know what we're doing. And then what do we see on this time frame? We see Euro USD 15 minute. We break above this high, have a retest, and then continue on. Have a break above, retest, continue on, and so on and so forth. Okay, kind of simple stuff, right? And then we also have that tap in the demand. What I don't want you to do, okay, what I don't want you to do is allow the news to decide your bias for the rest, for the first 1 or 2 days. Because when you just when you determine a bias in the first 1 to 2 days, guess what will happen? You'll likely get a liquidity grab. Okay, you'll likely become someone's stop. Your stop loss will become someone's take profit, or your stop loss will become someone's open position and things like that. Okay, so just wait a little bit, and then we usually trade this Thursday, Friday, and then obviously the weekend, and then we can trade it Monday, and then Tuesday when the new data release comes out. So typically we don't trade this around Wednesday time. We don't trade it Tuesday when it comes out, the Wednesday, but we can trade it Thursday. And a lot of you have been like, "Yo, Cree, why are your Thursdays so good?" If you guys look back at my alerts, well, now you know. Um, I was gonna start hosting lessons like this on my YouTube and stuff like that, but I was like, nah, this information's like this information's a bit too good. It's a bit too like interesting for YouTube. So I mean, there's a lot of stuff on YouTube to do with it, but kind of going through examples of how it actually worked. It's not really on YouTube. I haven't found anything. But yeah, should we go through another example? Why not, right? Let's go through the week after. So we know that this data got released at this time. This is where they accumulated. We had the distribution into this zone, accumulated more, and then the market was able to run. If we just quickly look back onto our positions, let me just make sure this is actually recording. Yeah, perfect. If we just look back at our positions, the net positions for long haven't really changed too much, and the net positions for short decreased, and increased for the buyers. The dealer. So we know the dealer's been given those short positions back. Okay, so that's not a good look. Right. Now we can go on to the week after that. And of course, it's not going to work like that every single week. We need to be quite snappy with it. We need to be having quite a good experience with this. It's not, sometimes data might get released and everyone's selling their short positions, and then the market does actually fall. Institutional traders aren't right all the time. And that doesn't mean, we have to trade with them in sync. Use it as kind of a bias, and then use your technical analysis to your advantage to then take advantage of what the institutions are doing as well. 9 times out of 10, they're right, but there will be some weeks where the market's consolidating and things like that. Also, just go like I'm picking up things as I'm going, or remembering things as I'm going. If there is not much change, so if the buyers aren't decreasing their positions, if the sellers aren't decreasing their positions, what does that mean for the market? What do we do then? Expect a consolidation phase. So the institutional traders might look at the news, they might look at the statistics, they might look at potential red folders that are coming out. Obviously, they're not going to do that, but like from our standpoint, they'll look at red folders, and then they might look and go, okay, there's not much news coming out this week. There's not many people talking. The market's probably not going to make some massive moves. There's no news coming out. So what we're going to do is just keep our positions neutral, and then we're going to attack when the time is right. How interesting is that, right? So usually if we have a market that's kind of running or selling, and then the week after that it's consolidating, this statistics will reflect that. Okay. So remember, every week they're accumulating or distributing, and then the week after their plays play out. And then as their plays are playing out, they do it again. They rinse and repeat. They do this every single week. Okay, right. Now we can go on to, so what did we just do? We just did in November. No, we did. What did we do? Let's go on another random one. Let's go October 17th. Let me look at the statistics from there. Nah, that's not very good. Let's go November 28th. Okay, this one's good. We didn't just do a November 28th, did we? Okay, we didn't. Let's go on November 28th, shall we? Okay. So November 28th is here. Okay. And then this is where the market was accumulating. And you'll guys start seeing patterns where sometimes maybe you don't even have to look at the statistics and you'll start to get an idea of what they're doing. So this is where the this is where the statistics start coming out. So this is where they start accumulating and distributing. So it goes November 28th, and then the news after that come out uh, just a week from then, isn't it? But I'm not going to wear that on my head. 28th, and then 5th of December. So we go to the 5th of December. It's around there. Okay. So what we'll do is we'll go on an hourly, and we'll kind of look what they did throughout this zone, and then I'll bring up the statistics. Oops. Okay. Now, guys, what do you think? Type in trade in chat. What do you think the market has done during this phase that I've just shown you? What do you think the market's done? Tuesday, November 28th. Anyone know in trade in chat? Anyone can think of what the market's done, or what do you assume that the asset managers have done? What do you think? Anyone? Or am I speaking to myself? Kind of, there's 14 people in here right now. No one can guess. No, no one. All right, I'll guess. I assume that they'll be building long positions. Okay, so we have this sell-off. We assume they're going to be bringing long positions. So then what I'll do is I'll go here. I'll pull up the statistics. Say I assume I did. I did see the statistics before, but you can kind of guess that they were doing that anyway. Right. So this is this is the statistics for this kind of move here, right? So we can go from here to about there, draw it up, and then what the market's done in this phase. If we go to look at the dealer has increased short positions. Okay, so that means people have been given their short positions back to the dealer. They've increased their long positions. They've decreased their short positions. Leverage funds has kept quite neutral and then decreased their short positions. So what do we assume that's going to happen in this zone? We assume that the market's going to run. Okay, if I haven't seen what's going to happen, but we assume the market potentially goes on a small run, but we'll see. And remember, we do have these non-farm payrolls and things like that coming out, so that may affect the market. I'll just quickly go on to my Forex Factory. I know my CP. Okay, this is where it gets interesting, guys. So if we go December 28th, when was this? Oh, the December 4th. Sorry. Wait, was it? Oh no, November 29th. November 28th to the 5th of December. Yep. And then the next release was the 12th. Okay, so around that. So of course they are decreasing their short positions, but increasing their long positions. We did kind of get a small sell here. Okay, so for this week the information wasn't really kicking in. Okay, if we just change the date from the 28th to the 5th. Wow, this is where it kicks in. Okay, it's actually really, I love this. I love doing this. This is really interesting. I'm such a nerd. Um, okay, so this is the data release for this period of time. And then, of course, this is where it played out. It didn't really do too much. So we would have been looking for long positions, but unfortunately, the market just kind of consolidated in this small downtrend. And then we got the news release of what was actually going on here. And as you can see, we have a huge increase in long positions from asset managers, which is followed in continuity to the other week. We have also increase the short positions for the dealer. So that means people have sold their short positions, and increase for leverage funds on their long positions as well. And so on and so forth. They did increase their short positions a little bit, but that's fine because the long positions go over that. So in this time, this is when that news got released. And as you can see, that is where it played out, where the market actually had that pop from there. Okay. And then as you can see, that was the 13th of December at that time. And if we go back, right? If we go back to potentially this time, that news was the FOMC. Isn't that really interesting to you guys? Like, is it? I'm genuinely curious. I'm asking a question now. Do you find it interesting that they were accumulating longs for 2 weeks, and then FOMC come out on the third week, and FOMC actually pumped? Do you think that's quite interesting? Right. I personally think that's quite interesting. Anyway, but yeah, and as you can see, the first day we don't really trade too much. That's kind of where the market accumulated, and then that is where the news released, and then it actually popped off. Okay. Yeah, it goes off. We actually took the market. Oh, you just talking to someone else. But yeah, that is the lesson, guys. I spoke about a lot. I spoke about COTs. There's a lot more information that actually goes on in the market. We spoke about news releases and what we need to take into account, what we don't need to take into account. We spoke about what the actual news release means, how it can affect the economy, what actually affects the economy. So every time you guys now go and buy a new microwave, dishwasher, oven, think that you are adding to the statistics that we are getting from FOMC, PPI, all that type of stuff. And it's quite interesting. Okay. Um, so yeah, I'll release some notes on this. I'll release potentially a quick 5-minute video just explaining in a summary, a 5-10 minute video in a summary, because I believe this lesson was 51 minutes, which is great. So yeah, did everyone find that useful? Did everyone find that quite interesting? You can let me know in trading chat or unmute your mics. Man, everyone's so antisocial today. Um, I guess you're all just overwhelmed from the extensive knowledge that I just gave you. But yeah, I would recommend going back test this. Use the website. I'll put the website links in chat. So I'll put that in chat, and I'll put this in chat. Of course, that is just the simple websites you guys use for this lesson. Yeah, I appreciate you all for hopping in. Appreciate all the support. And on Tuesday, I'll do a review of this, and then we'll see how we can act in the markets later. Now I've released this to you guys. Now you guys know how to use it. We'll be using it a lot more in VC and in my alerts as well. Need to go over it again on my own to understand it more. But thanks, Cree. Honestly, I would recommend doing it. Like I said, been doing this for a long time, and I mean, it's not necessarily my explanation on how, like, from my perspective, because I know it, my explanation through this whole lesson has been quite mint. Like, it's been pretty good. But when you're trying to talk to someone that has absolutely no idea what COTs are, it will definitely go over your head, but it will click. Trust me, like, it will click. Like, the stuff I was saying will make sense soon. I promise. You just kind of need to spend a bit more time in it. Maybe like even Sunday evening, just watch the video again, get an idea of what I was kind of talking about. Maybe do a bit of back testing for yourself. And the best thing is experience. And then what MLJ, another good thing that I do is I'll like I'll like see my mom and I'll explain it to my mom, or I'll talk to my girlfriend and explain it to my girlfriend. I'll try explain it. And when I do lessons like this, of course, it's amazing for me too, because I'm allowed to go through it again, and I have to make sure I'm right in what I'm saying for you guys to understand. So it kind of makes me, go over things and check things. That's why sometimes I take pause in lessons just to make sure I'm doing it right and whatnot. Because it's not as simple as, you draw a line here, then a box here, then this there, and that there. This is like, not, I wouldn't say next level. I think it's quite simple, but it's definitely something that not many traders do. And like I said at the start of the lesson, fundamentals are an amazing part of trading that could drastically change your trading. Most people say, "Oh, my best day is on a Thursday." That's probably like, because of this, if that makes sense. But yeah, it's a great way to get bias, and it will really help you, I promise. So yeah, right, I'm gonna head out, guys. I'm gonna go chill for a little bit because it's the weekend now. I appreciate you all hopping in, and I will see you on Monday morning. Have a great weekend, guys.